In this video, let's talk about two ASX tech stocks that you shouldn't ignore, and then we'll talk about Australia going to deflation since 1997, Apple's 4-for-1 stock split, and then we'll wrap up the whole video with a portfolio update. As usual, I'm just a shaved head Asian dude making investing videos on the internet. So, should my videos be used as financial advice?
Heck no!
And that's why if you ever need help, make sure you talk to a proper professional. And if you want to support me, just gently smash that like button right there if you learned something brand new in this video, and that's more than enough to support me. Now without further ado, let's go! Okay, so for each of the ASX tech stocks, I'm going to be covering what they do, how they make money, their financials, and some of the key risks, as well as the things that I don't really like about the stock. And that brings us to the first Aussie tech darling, and that's Xero. Now, as of recording this video, Xero is currently trading at $89.94 with approximately 12.79 billion market cap. Now, Xero is a B2B cloud accounting software as a service company, and they make majority of their money with their monthly subscriptions to small businesses. So I personally use Xero for my company. It's super simple to do repeat invoices, reconciliations, and payroll. Basically, a lot of the boring paperwork that you need to do as a small business owner. Now, not to mention that their marketplace and integrations have grown to the point that makes operating a small business very, very easy. For example, one of the biggest headaches when it comes to owning your own company is that
you have to spend time chasing invoices.
And having an integration between Xero and Stripe, which is a US payment processor, it enabled companies or small businesses like mine to do recurring billing, which basically just means automatically withdrawing a certain amount from their bank account every month. That honestly makes life so much easier for the party invoicing as well as the party who have to pay. And over the last 5 years, they have grown their earnings by 40%. And most importantly, for the first time in a very long time, they have posted a full year net profit of $3.3 million. And that is a big deal for software growth companies. So hats off to the guys over at Xero for making that a reality. Now with software companies, it's really important to look into their unit economics, because that will tell you how the company is managing the cost structures as well as whether they are continuously creating value for their subscribers. Now what you see in front of you is the unit economics behind the business and the breakdown between ANZ, international, and as a whole. Now I'm not going to make comments on the unit economics first. Let me just explain to you what each of the metrics actually mean. ARPU is average revenue per user. And in this case, a user will be someone paying for the monthly subscription in Xero. CAC months means how long does it take for the value of the customer to be at parity of the amount of money that you spent to acquire that customer. CAC actually stands for customer acquisition costs. So a CAC months of 14 means that it takes 14 months for a subscriber's economic value to be at parity with how much Xero has spent acquiring that customer. MRR churn is the amount of recurring revenue that was lost as a percentage of total recurring revenue at the beginning of that month. So MRR stands for monthly recurring revenue. For a metric like MRR churn, you want that percentage to be as low as you possibly can get it, because that shows the product is really good and customers are willing to come back and basically stay with the subscription. LTV is lifetime value, and that essentially measures how much a subscriber is worth over their lifetime. And based on the information given by Xero, it seems that a customer's lifetime value is approximately $2,422 with an 8-year lifespan. So let's circle back to the original graph of unit economics that I've showed you before, and there's a couple of things to point out here. It goes without saying that the ANZ business is making a rain. LTV to CAC is approximately 10 times, which means that the lifetime value of the customer is worth approximately 10 times of what they spent to acquire the customer, which is great, by the way. Churn is really low, which means that customers are staying around, and there is really good growth happening in the subscribers side of things. On the other hand, the international markets still need a lot of work. It takes about 18 months to recoup how much you spent on acquiring a brand new customer, not to mention a higher churn rate. But the one thing I want to make a note here is that a single digit churn rate is an achievement on its own. It's just comparing the ANZ side of things to international, there's still a lot of work to be done. And it also seems that Xero's cost structure is more weighted towards sales and marketing instead of spending more money towards product design and development. Now, whether you can improve your unit economics by spending more money on marketing, only time will tell. And I want to make another note here that it is expected for the international unit economics to be not as good as domestic because there's a lot more well-capitalized competitors out there like Intuit's QuickBooks. So let's dig a little deeper and look at their balance sheet. From a single glance, they should have no problem withstanding any external shocks in the short term. If you look at their current assets, 500 million of that 700 million of short-term assets are cash. I mean, seriously, they have enough cash in this environment to conduct even more M&A transactions to grow even faster if they want to. On a side note, if you're curious, over the last 12 months, if you look on LinkedIn, they have increased their headcount in the corporate development space, hiring for M&A transaction analysts as well as managers. And you definitely don't go hire these expensive headcount for fun. So I'm not going to comment too much about their valuation at this point because their financial year ended on the 31st of March 2020, which is literally at the deepest point of our recent stock market crash. So we have no idea how their customers were affected. We have no idea how their affected customers have affected their unit economics. And during the investor call in May, a lot of the analyst questions were sidestepped. But I would love to know what you think about the valuation at $89 per share, whether you think it's too expensive or currently a fair price. So let me know in the comment section below because I would love to talk to you about that. Now the next ASX tech stock on my list is Volpara Health Technologies. As of recording this video, Volpara is trading at $1.34 with a market capitalization of $334 million. Now Volpara will be slightly unknown to most of you because our tech darling coverage will basically drown out all the coverage on Volpara. And please bear with me since YouTube is really sensitive to the scientific word that describes the lady's chest area. Instead, I'm going to use the word lady bits to describe the lady's chest area. Now Volpara is a New Zealand-based software as a service company that utilizes machine learning algorithm on lady bits mammograms to improve early detection of lady bits cancer. Now currently, lady bits screening is approximately a 1.1 billion New Zealand dollars recurring revenue market opportunity. There are approximately 39 million women getting screened every single year in the US, and 27% of those women getting screened in the US uses at least one of Volpara's products. That means in the US they have a 27% market share. And since last year, they have grown their annual recurring revenue from 6.6 million New Zealand dollars to 18 million New Zealand dollars. And that 172% growth is largely driven by two things. One, their software actually works by helping radiologists with early cancer detection. And two, because the software actually works, there's a return on investment for the clinics by reducing the cost of unnecessarily recalling women to do additional screening. Volpara is not making a profit yet. So instead of looking at the negative earnings graph, let's jump to the balance sheet to see whether they can withstand any external shocks in the short term. And also, I want to remind you that I've turned everything into New Zealand dollars for ease of understanding. What's really interesting when you look at the balance sheet is that 31 million out of that 40 million in current assets is cash. And since their financial year ended on the 31st of March, this balance sheet actually didn't take into account the additional 37 million capital raising that they did after March. So taking the fundraising into account, they should have approximately 68 to 69 million New Zealand dollars in cash. And they have raised this money mainly for the purpose of M&A transactions. And if we take a deeper look at the debt to equity ratio, I can't even comment because they have no debt. So let's talk about some key risks Volpara is facing right now. Now, because screening is not considered as essential services, a lot of screening were paused at the peak of our pandemic. The thing to remember here is that LadyBit screening, although it's not considered as an essential service, is a critical service. So there are pent-up demand for ladies to do their screening as soon as it's ready to go again. In May this year, CEO Dr. Ralph Highnam actually mentioned that the screening has started again. And another concern with Volpara is the super niche market in lady bid screening for the chest area, that is. Since to some people, it's only a 1.1 billion New Zealand dollars recurring revenue market opportunity. Again, in an investor presentation in May this year, CEO Dr. Ralph Highnam has mentioned the acquisition of MRS system in 2019 actually enabled them to do patient tracking for both lady bids and lung screenings. Not to mention, lung CT are viable with the intellectual property Volpara has. But CEO Dr. Ralph Highnam has reiterated and re-emphasized in the same call that even though their intellectual property is viable in other areas, in the short term, they are focusing on lady bid screening as well as patient tracking for now. Overall, I really like this company. It's a founder CEO-led company, and CEO Dr. Ralph Highnam's first PhD thesis from Oxford is on mammography image analytics. And there is just real depth to the management team with both doctors and engineers. And the one thing I really appreciate listening to Dr. Ralph Highnam is that he's so transparent with the pandemic situation. He never sidestepped any analyst questions, and he understands his numbers really well. And contrasting that with the Xero investor call, if you listen to it, you know exactly what I mean. All right, let's talk about Australia heading into deflation for the first time since 1997. The ABS just reported Australia's consumer price index fell by 1.9% from the March to June quarter. Now, when the consumer price index is positive, that means that the general price of goods and services are increasing. So this is also known as inflation. Now, on the other hand, when it decreases, it means that the general price of goods and services are decreasing, therefore deflation. So whenever we hear the word deflation, people tend to freak out because it's usually used together with the word recession. I'm going to explain in a second why I'm not too stressed about us heading into deflation for the first time since 1997. But before I do that, let me just explain what happens when prices continue to drop for a long period of time. Now, if prices continue dropping, let's say we're buying a TV and say for the month of June it's 50% off. And then for the month of July, it's 75% off. And you just basically as a consumer, you're anticipating the prices will continue dropping. Now, if you anticipate that the price will continue dropping, people will just stop buying altogether. Because then what's the point of buying at a higher price? Because you know that in future months, those goods and services will be a lot cheaper. Now, if people stop buying goods and services altogether, retailers can't make money. And if retailers can't make money, they either can't buy more supplies from the manufacturer or basically they have to fire some of their employees. With both cases, what will happen is there's going to be an increase in unemployment. And if there's an increase in unemployment, there's no money to go around. There's no money to spend. That's essentially why people freak out. And if there's a long period of prices continue dropping, then yeah, that'll be a concern. But in our case, that shouldn't be something that you're worried about. So let me explain why I'm not too stressed about us heading into deflation for the first time. Now, the reason why I'm not overly stressed about us heading into deflation territory is because our federal government is helping us a lot when it comes to childcare costs and also preschool costs. Preschool is free in some states. And if we compound those two things with cheaper fuel prices, those are the only reason why we are in deflation territory. Now, if we just remove those long tail events, our consumer price index actually went up by 0.1% in the March to June quarter. Honestly, I just think this is our federal government giving us a helping hand. And I'll keep an eye on this. If there is any new developments, I'll create another video to explain how that will impact us. The next thing I want to talk about is Apple announcing their 4-for-1 stock split on the 30th of July 2020. The whole point of doing this is just to make it a little bit more accessible for retail investors who don't have as much capital to invest. And this is purely just a cosmetic change. There's no changes to their valuation and there's no changes when it comes to the percentage dividend yield. So let me give you an example. If you currently own 1 share of Apple, they will issue you 3 more. So that means in total, you will have 4 shares for your 1 share that you originally had. And say they had 82 cents per share currently, it will just be split evenly across those 4 shares. So the percentage when it comes to your dividend yield percentage, is exactly the same. Nothing is changing when it comes to their valuation. Nothing is changing when it comes to the percentage dividend yield. They're just making things a little bit more accessible for people who don't have as much capital to invest in. And also the day after, Apple has revealed their earnings and they have surpassed Saudi Aramco to become the world's most valuable company. Their revenue is up 11%. Their earnings per share is up 18% comparing to the quarters from the previous year. And the one last thing I want to talk about here is the antitrust hearing with the tech giants recently. It was aggressive, it was unsatisfying, and just generally incomplete. But it's still worth your time, in my opinion, to sit through some of the highlights of the hearing because Jeff Bezos' opening address was really good, and you can just witness the unsatisfying questions from the policymakers yourself, because any loaded question from the policymakers, they don't let any of the CEOs answer the question at all, and they'll just straight up cut them off. And for me personally, there was a lot of valid questions being thrown at Google, or Alphabet in this case, for taking Yelp reviews and displaying them as feature snippets and third-party data being used by Amazon to launch private label options. So there's definitely some very valid questions. And as much as I wanted to talk about the Instagram acquisition questions that was thrown at Mark Zuckerberg, I'll save that for another day. So let's go through a portfolio update. Now, over the week, I made two major changes to my portfolio. I have consolidated Milton Corp and my InfoCare position into Argo Investments. Now, the reason for consolidating both of those positions are pretty simple. Milton Corp had too much bank exposure, and with InfoCare, I just didn't expect the pandemic to affect them this much. So I took my losses in both of them and I reinvested everything back into Argo. Argo's portfolio is a lot more well-rounded and their ex-dividend date is on, I believe it's late August. So I thought, well, might as well end the year with a nice cash check. And that's basically the big move for my portfolio. The one last thing I want to mention before we move over to the stake portfolio, I am very, very happy with my AMD position. I bought in at $49 and I completely ignored the exchange rate at that time because I knew that it was just a minor setback, and not even a setback. They were doing everything right. If you just go on YouTube and just search for AMD, you can see the raving reviews and the review differences between Intel and AMD. So I'm planning to do a full video on this sometime in the future. If you'd like to see that video, let me know in the comment section below by giving me a thumbs up. If we can get 100 thumbs ups in the comment section below, I will create a full video on AMD and just show you all my research. So let's go over to stake. Now with stake, I unfortunately had basically $300. I bought some more Tesla during the week, and then there was extra money left over that it was either unsettled and I couldn't put the trades over. So on Monday or Wednesday next week, I might give you an update in terms of what I ended up buying. Now last week I bought some more Apple, and I wasn't really anticipating that they were gonna crush their earnings. I usually just dollar average into Apple, and that has turned out to be in my favor. But nonetheless, there's no major changes with my stake portfolio other than the fact that I usually convert all my free stocks like GoPro, Nike, and Dropbox into stocks I like. And on that note, I'm not sponsored by stake, and if you want a free stock in either GoPro, Dropbox, or Nike when you try stake for yourself, I'll leave a link in the description box below so you can help yourself. Now, the one thing I do want to potentially look into a little bit more with this portfolio is that even though I am focusing on dividends, my portfolio structure right now is basically 80% in dividends and 20% in growth. And I want to slowly shift that towards 60% in dividends and then 40% in growth, like pure growth stocks. And one of the things I'm potentially looking at is I want to consolidate some of my banks, like for example, Bank of America and also JP Morgan, just have a smaller amount of positions. So essentially selling this off and putting it into either BlackRock or T. Rowe Price. Really happy with the T. Rowe Price position too. I really, really like them. A lot of these companies that I own, I just generally like them and I want to hold them for the rest of my life. I don't plan to do a lot of buying and selling. So that's essentially it for my portfolio. And that's essentially it for this video. I really enjoyed talking about tech stocks because this is something that I'm quite passionate in and I love learning more about it. So if you learn something brand new, make sure you gently smash the like button right there. And when it turns blue, you have done a great job and that's more than enough to support me. Make sure you subscribe to my channel, click onto the bell. When my future video is ready, you'll be the first one to know. Until next time, my name is David. Auto will always do the honors and see you very, very soon.